Hello, everybody. Brian here from quantlabsnet.com. This video here on July 3rd is going to go into very deep detail on what I'm seeing in the markets. Now, what I'm about to show is real live market data. Just downloading real live option chains, real live futures data. And here's basically the summary of it, the executive summary we can call it. I'm going to go into bigger detail here on this. I've been running this particular dashboard, again, 100% AI generated, since last night. So here's the overall performance of this dashboard. This is involving futures trading and options trading combined, generated all by AI. But what I want to show you, this is all simulated right now, but I can probably attach real live data to this. So since last night, it's $100,000 simulated portfolio. So since last night, we've been able to generate over $20,356. So that's a 20% return over the last overnight since last night. So since the markets have opened for the last 3 hours, it's added on another probably 4,000. So I'm going to show you how this works. This is the overall summary. So right now, I ran a whole series of reports. These are the very detailed level of reports, about 45 plus. Depends on the market conditions, but if I just do a doc here and an account on the available, just to show you. So right there, you see 47. So sometimes there's going to be a bunch, and then there's other ones that don't get generated, as I said, based upon market conditions. So the takeaway here, when you look at this, the one thing I'm going to show you a summary of what's generated from all those reports. Again, using AI, taking all those reports and then feeding them back into an AI, and then generating the actual summary report. So I'm going to show you all that. But you can clearly see out of these picked strategies and assets, the clear winner is this one. ES, simulated, and then there's LE, JPY, and CHF. Okay. So this is obviously dependent upon volume. There's no leverage now added in Forex at all. I don't see the point, because if you have one asset, in this case, ES, or futures ES, why bother trading everything else? So as part of the AI, because it's so good, I'm able to generate different strategies. You can see them here. Which one's generating the most profit? And then I can disable the ones that are not making profit and only focus on the one strategy, or maybe a second strategy that's making clear, that's a clear winner. And then I'm going to add this as a change, and I can just tell it what to do, and it'll generate a new script for me where all of these have certain weighted allocation of $100,000 portfolio. Just so people know, $100,000 portfolio gives you more opportunities across different instruments. But if I was to say I'm going to keep it at 10,000, you're going to have fewer options. But if this continues the way it's going, and I've run these simulations many times before, as you may have seen, as I said, you might as well just focus on one or two that are the clear winners, and maybe a $10,000 portfolio is enough to just focus on that for that time in the markets. So that's the general performance. So let's go over to the dashboard overview. And again, what you're seeing, and I've said this before, is a Python Streamlit app. I find Streamlit's the number one web front out of anything I've seen. I've tested a lot lately, and this is the ones that do the best. So you can see here I've got ES allocated here in blue, and all the other ones are all allocated. Okay, and here's the current pricing. Okay. of the contracts available. Again, futures and options. And then again, you can see here, we've got live cattle, E-mini, S&P 500, KC wheat, Japanese yen, and Swiss francs. Okay. So you see, I can refresh the data, and like these are little functions that I don't need to do anything. It's just automatically generated by the AI. So these are some of the trades for the last however time frame they are. So you can see some of them are all profitable with the cumulative P&L on each. And as I said, I can disable the ones I only want. So I have ES simulated trading doing very well with a profit. Nothing else is doing well. I've turned off some of the losers. So if I kept this running, KC simulated trading, I'd have losers on my among the simulation, which I don't want. On top of here, again, I can allocate strategy management along with the, as I said, the cumulative P&L. You can see here, here's the big winners, but this is the big winner here. And that's the one I'd really focus on. People don't really understand when it comes to average cost trading, adding a little bit, and then Bitcoin goes down as an example. You hold on to that in a losing position. You're losing not just that, but you're also losing with opportunity costs. That's what I have. I talk about these things in my course, futures options course, because if you want to trade and do very well in trading, even if the world's on fire, the futures and options market is the best place to go. So here's the current market. Let's see. So we have here different types of option strategy. We have a volatility arbitrage. Now this is getting institutional, and again, I cover these in my course. But as time passes, the AI advances. I get more sophisticated with these type of building out these dashboard simulations. So does my queries or prompts. The results get more sophisticated as well. So we've got here pricing inefficiency, arbitrage, and anomalous correlation. So in here, we've got all the different available strategies. And again, these are generated from the Word document summary I'm going to show you. I'm just showing you what's happening right now. So the one that's making the most details here is E-mini S&P conversion arbitrage. Okay, so this is just one example where we have an ES price chart. Here's the details. Again, strategy consists of put call parity. I'll show you that in a minute. Principle by executing conversion. And this is what a lot of the hedge funds are doing. This is what a lot of high frequency trading shops are doing, and a lot of the banking is doing as well. The thing is, if you really want to get a high lucrative job in trading banking, I just learned that Goldman Sachs managing directors now are being paid annually $9.5 million in London, US, $9.5 million. So this is the sort of stuff you need to know. This is what they trade, and they do exactly what I'm showing you here. The only difference is now I'm showing you the AI so deep, so advanced, and where it's at. So again, we have a selling one ES future contract, buy one call option, sell one put option. Okay, that's a combination synthetic trading. This strategy looks for risk-free profit by exploiting the pricing efficiency between the options and the futures market, because that is the data I'm feeding it, where I go so deep among 47 instruments. This one appears to be the most profitable, and this is one of the strategies that can do well, as an example. Okay, so we have a call put premium difference, futures strike price difference, and net arbitrage. Okay, this is why you let it run, and if you let it run, call it a high frequency or what your broker will allow, and you can make good money here if you get these calls right. And from what I'm seeing, because I'm now testing these to see how these perform, and they do exceptionally well in the right conditions with the right type of options. Futures combine strategy and timing is the other big thing as well. So that's pretty well one of the strategies. Let me see if I can pull up this one. So we have here for LE, short strangle or correlation spread. Okay, so just as an example here, so this is lumber, and you can see here it's a different combination. Sell 2 LE call options, sell 2 LE options because there's an extreme discrepancy in the implied volatility and historical volatility in live cattle. Sorry, that was lumber. Live cattle. Entry, now I've asked now in the AI to prompt for the entry point and the exit point, and if it applies stop loss. As I get more advanced, in case things, let's say, go to rat poop, basically I could then say, do I add leverage, let's say in currencies? Because as I've shown you, if I had the capital in my account to take the risk on adding leverage, I could maybe do it. I wouldn't do it, but there's sometimes the opportunity here. So again, you can see here, bid ask, volatility analysis. So in a summary, you'll see that it focuses on lower volatility on the annual historical volatility. So here it's saying that there's a big difference with the implied volatility and the historical. So it will use a proper option strategy to take advantage of that. Okay, so these are just some of the examples. I'll show you the other lumber as well, or cattle. I'm not going to show you the currency ones because they just don't make it as much. But you can, if you're a member of mine, you can clearly see. So there's no data here. This dashboard. Okay, so we've got strategy management here. Let's see what we got in here. Now I want to show you this. Okay. So we know the types of strategies we have. This is the important part right here. Is, as I said, we can turn off, toggle on or off which strategies we want. Okay. And then we have the strategy cumulative P&L right here. Okay. I've shown that before. We've shown the strategy details. Okay. As you can see here. What I can also do with sophisticated, depending upon the data provider, I'm paying now with a new data provider that seems to be reliable and good, and that is not going to cut me off like the other one that just went all crappy on me. This one looks pretty good. So this is, again, the E-mini ES. Okay, so this is the current option chain. And I'm going to show you how deep this goes because there's various option chains of option contracts that I can take on. And this report now goes so sophisticated, it will generate full-on analysis for each option chain. Like it's that crazy. So you can see here we got call implied volatility at 20%, put implied volatility at 26%, historical at 19%. Okay, so I could show you, I'm going to only show you the cattle, because that's another one that's been traded as well. And you can see similar data types here. Okay, so let's take a look at the trade execution in detail. And again, this is generated by AI. It's absolutely pretty incredible. So we have the ES arbitrage conversion. Okay. So here, the trade setup is this. Sell one ES future, buy one call option, and here's the strikes. Sell one put option. So we'll go out and choose the proper option contract that it thinks is best. So we want risk-free profit from this arbitrage opportunity. Okay, so I could add the trades manually if I want, but it's fully automated. Okay. So now, I think I've shown you the simulated. Okay, so it's simulating every 3 seconds, just so you know. Okay, so here's the current prices, blah, blah, blah. The interesting thing is on the win-loss ratio. There's the ES. So that win-loss ratio is pretty high versus the other ones. Okay. Here's the recent trades. And I've shown you the performance analytics. Okay. So now what I'm going to do is I'm going to go into the summary. This is the summary. Actually, let me do this. For those that are new for what I'm doing, this is going to probably blow your mind. Okay. So what I've got here is this is the raw data that's generated, the reports. But as I said, I've advanced it now where it's not just going to look at one option contract, it's going to look at them all. And then from there, it's going to optimize that. And then when I feed it back in to a general summary, which I'll show you next, it will show you how advanced this is. And this is real life data. And the option chain data I could get goes out anywhere from 4 to 6 weeks, which is optimal. For best analysis, you want to have it look at least 3 months. 3 months optimally. But you got to pay a lot of money for that. Okay. So right now we got 4 to 6 weeks out forward looking with the option chain data. So what I'm going to show you now is the raw report of this. First, I want to just show you how many pages is this. This used to be 40 pages now. This now goes well over, I don't know the exact amount, but right here, as it loads it in. So right now it's 300 pages, still loading it in. It goes over 1,000 pages. So from because of how liquid, so there you go. You got almost 1,200 pages in there of data reports, and this is what it is for the last, and that's for every single contract in the option chain. Okay, so it analyzes them all, and then picks out which one's the most optimal out of 4 to 6 weeks. Okay, so here it does the hedge math, all the relationships, calculates the implied volatility. Uses the Greek analysis. This is the important stuff right here, is the call put parity. The summaries in the AI always comes to this because it's supply and demand, and it uses that to see if there's an arbitrage opportunity. So then it will also apply risk frontier as well. And this is exactly what HFT shops do. And again, this is what exactly the hedge funds, the banking does as well. All this type of analysis. Okay. This is now real. Okay. This is real data now. We're feeding it. Okay. So we get our payoff diagrams. Okay. We've got different kinds. We've got bull call spread. We've got long. So these are bullish strategies. These are popular option strategies out there. Bull put spread, bearish now, long put, and so on. And then we have the risk neutral or neutral short straddle payoff, short strangle payoff, and it does this for every single option contract in the option train. Then it will look at if there's calculates iron condor, all the variables that are associated with that. And these are the more sophisticated strategies. Okay, so we got the butterfly, the condor, as well, and the payoffs, the holding strategy as well, or hedging. Sorry. So these are very useful for when the markets go bad, and this is kind of a way to analyze the markets and which way they go. So again, we have some hedging here, payoff analyzer, and these can look kind of wonky depending upon the opportunity. Cash put payoff. This is just one option contract, okay, combined with the futures as well. So here it's looking for arbitrage, and this is where it comes up with that information on what exactly to arbitrage and at what level in the volume. So we have our arbitrage right here again. So we have an arbitrage analysis for ES. Okay, one contract. Okay, this is how deep I've made it. Potential arbitrage profit of $53. So here's all the detail of it. Okay. Profit loss scenario. Okay. So essentially, I mean, this is one contract. So here we have the options borders that we want to trade within the golden area for ES. Between these prices right here is your gold ratio. That's another key factor here. And again, it will then go out and start generating The next, so this actually, sorry, this is the hedging, detailed hedging math with all the covariance, variance, all that fun stuff. And it just goes very deep. Okay, and it tells you the base, it's going to calculate basis risk. I mean, I could go on and on and on and on and on. Downside risk, here's the upside of just future hedging, call option hedging, so on and so forth. Okay, so enough to bore you to tears there. So this is now the summary of all 47 contracts of instruments. I make them deep. Give me as many word analysis as possible. So here we're looking at volatility, arbitrage, pricing inefficiency, and anomalous correlation. Okay, and using this summary, I then turn around and create that trading dashboard I just showed you with the Streamlit right here. So if you look at very carefully here, all of these strategy types are coming from this right here. So these are all the major strategies. So the other important part here is the allocation. On a mock portfolio, 100 grand, 40% of it should go towards Kansas wheat, arbitrage opportunities, 40,000 allocated to S&P 500, the ES, and the other one on live cattle at 20K. That's what it's telling me in the summary. From what I see, the Japanese yen kind of traded last night. There's a little bit of profit. Today live during the US market open, there's some opportunity with live cattle. But again, if we know that we've got in our running summary here that we know most of the profit's going to come from the ES right here, as you can see, ES right here, then why would I put the risk on for little profit where I can get amazing profit level from the ES trades? So my point there is a new parameter I'm going to add to the AI is say, hey, look, not only will I sit here and have the option to disable and enable strategies. Let's see here, right here, strategy manager. The other thing I'm going to add in is portfolio management. So if I know certain strategies are performing really well, I'll disable all of these to lower risk of loss and have a new feature added in. If I'm going to allocate, let's say 100 grand, okay, 100 grand right here, and I know I'm going to get that through just trading ES, okay, and then what I can do is say, take all the available portfolio and trade in the ES only, and add that as a new request to my AI prompting to have that new feature in, so I can take, instead of allocating 40% to, let's say, live cattle or 20% to CHF, I could say no. From the results I'm seeing, turn all of them off, and then allocate all that capital 100% to the ES trading, because that's how you maximize your profit. All right, so here's the first part, the analytical framework. So it's kind of trading on these discrepancy, structural mispricing. Okay, so it's using maybe volatility analysis, historical or implied volatility. That's why you see that feature, because that's what this summary is suggesting. And then therefore, as part of the input and the prompting process, the AI will generate all these features in the new simulation. So this new AI or simulation that I can build to run, it will generate everything I need from the summary and generate a new dashboard that I can trade and take full advantage of. The other thing that it seems to be taking advantage of currently off the real world data is arbitrage and put call parity. And I'm going to show you that with the one in the other document, raw document for ES. Okay, so here we have the put call parity. And basically what it is a risk-free profit opportunity from price discrepancies of the asset across different markets or forms. They're looking for violations of the put call principle. And every single HFT shop will always use call parity. They won't talk about it, but this is where they make a good bulk of their profit is from the discrepancies in high volume assets, and they can do it again with a combined set of options and futures and set out all these different multiple strategies for that one asset and then come up with a different type of strategies to apply, as you saw in the AI. So it's using this what called parity. So here we go. So in here, it's using this formula and it's live and the most recent data from both futures and futures. So the futures is the past data and the options is going to be coming from, or is the future of the 4 to 6 week outlook using the real world options data and not just using option chain or option contracts, but it's using them all across all available in the option chain. This is how powerful this is now. Okay, so now the examples here, as an arbitrageur, simultaneously buy the call, sell the put, sell the futures contract to lock in guaranteed profit. And the AI is doing that. Reports for instruments like the E-mini, Live Cattle, and KC Wheat. Okay, so it's using things like correlation and optimal hedging. So here, with the correlation coefficient parameter, the degree which two assets move in relation to each other. Now, again, my course on futures and options goes into very detail into this over a 5-week course. It's so important people understand this concept to really not just maximize profit potential, but when there is profit, like I've shown you with the ES, you want to just pour it on and just just maximize as much as you can. So here, this is what the report's saying. The report for live cattle, as an example, has a staggering correlation of this and a corresponding negative optimal hedge ratio, presenting a unique opportunity to construct a market-neutral position that is exceptionally well insulated from overall market movements, profiting instead from the statistical relationship between the cash and the futures price. And again, I go over that through my futures and options course. Here now, the AI is telling you that based upon the data it sees and the kind of data I provided. By combining these three pillars, we can identify, structure, and allocate capital to a series of high probability trades designed to exploit the specific quantitative and structural characteristics revealed in the source documents. And those source documents are these that I provided. These ones right here, all of these 47. You can see how big they are. So the ES is probably going to be, that's a big boy file. And I'm going to show you that. That's that over 1,000 page. So using that data, okay, this is the kind of prediction we get. Okay. So as an example, using, let's say, live cattle, triple threat opportunity. And this is, again, the AI telling you this. Okay. Now, we know when we run it, this one does okay. Let's focus on the one that is the golden goose, we'll call it. The E-mini ES classic arbitrage in a very liquid market. Signals clear all by smaller arbitrage opportunities, one of the world's most liquid markets. So here you have your data synopsis, historical volatility, implied volatility in the call and the put, correlation, which is a zero correlation, and arbitrage signal, profitable arbitrage opportunity exists. Okay. And that's probably where the profit's being driven from overnight trading, simulated trading, I should add. And strategies to buy, call, sell, put, sell futures to maximize that. So it's not doing it once. It's doing it. I don't know how many trades it's doing because I tell it, do it like high frequency trading, and you see the results, 20% return overnight. So it's a near zero correlation. ES futures according to this data. Poor hedge for the cash index over the observed period, a counterintuitive finding that may itself be an anomaly. Primary signal is the arbitrage opportunity derived from the call put violation. The recommended strategy is conversion. And when you look at where the profit is being driven from, this is exactly what's done it. So right there, you can see it's ES simulated, and there's ES arbitrage. So this ES simulated is probably the conversion. So here it's involving underlying asset, short futures position, creating a synthetic long position by calling a call, selling a put. Profit is locked in if blah, blah, blah. Arbitrage scenario analysis section of the report I just showed you, the 1,000 plus. I don't know which option contract it is, but it picked the one that looks like to be the most profitable. So here it's doing this call put premium, keeps a strike price difference, and this is all quantitative techniques, I might add. So it's a substantial 20% return overnight. Risk-free profit per contract spread. Document own P&L calc showing the losses inconsistent and will be disregarded in favor of the fundamental arbitrage formula. So here's the proposed strategy it comes up with. Trade the arbitrage conversion, gives you all the entry points. Execute, sell one ES, future contract, one call option, sell put option, and the exit, blah, blah, blah. Now, this is assuming over 4 weeks as an opportunity. And then, as I said, you got the Japanese yen, the Swiss franc, but the ES is the number one. Also included is the KC. So here's the $100,000 optimal portfolio allocation. So we've already gone through this. So here it's saying allocate 40% to the ES. Arbitrage conversion. Okay. Blah, 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 blah. Okay, so again, we go through all of that fun stuff, and it has exit points, entry point. That's crazy. And all these other different ones as well. But it's so sophisticated now. So then when we want to look at the risk management as well, there is volatility risk. I'll tell you if you use strangles on LE, KC, execution risk as well. This risk is mitigated to using spread order types and focusing on liquid markets like ES. So it's warning you what it's going to do. Okay, so data integrity, blah, blah, blah. And there you have it. So in essence, it's getting better, more sophisticated in the process that I'm coming up with. This is a very sophisticated way to do things. For me, it depends on the cost, really. So to be able to trade market data as well. But to me, how it works is in a conclusion is when you find an opportunity that's current, develop an AI or having your AI where you just turn off the all the little profit guys, but just focus on the one big profitable strategy. And then, as I said in my next simulation dashboard, I have to add in, okay, reallocate all that money that's been allocated, all that capital is reallocated to all these other assets, and just focus them on this one, which in this case would be the ES. This is where we're going now. And again, if you want to know more, go to quantlabsnet.com, sign up. We're getting institutional level stuff now with AI, using Python, 20% return overnight in the last few hours. We'll just check in there. But you can always just put your name, last name in there, and your email. How it's looking right now, if I go here, and I go back in the dashboard. So right now I have everything running. So I guess it looks like it's added on since I started talking here. You can see this chart here. It's gone up 38A. Is that right? It'd be pretty interesting during this video. Like you're making in an hour, doubling your money while the market's open. Let's see here. Okay. So something good has happened. Okay. Again, it's all simulated right now. But yeah, so there's just some pretty wild stuff happening right now. But you know where to go. I'm gonna end it now. But I think this is a big winner if this is valid. And there I can turn off. But you see here, I've added in, I've disabled the KC and just turn off all these other ones. But the problem is, does not mean that um, if I disable one, I'll have to put in my request into the AI saying, if I disable one, please allocate what's allocated to it to the winning assets that are making profit or the most profitable assets when I disable it. So this is uh, a very good simulator. But then I can build a real front end to it and then be able to run it with live money as well. But that's how it looks. So again, if you want to know more, just go here, quantlabsnet.com, learn, or to the main page. And I think as the time passes, the prices are going to go up exorbitantly if this is true. If this is a valid simulation with these kind of reports. Okay. So there you go. I'm going to sign off. Thanks for watching. Have a good day.